Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're speaking with Michael Cohen. He is president of Colliers Tri-State Region. When the firm operated as GVA Williams Real Estate, he was the third generation of his family to head the firm. He is also an asset manager of several New York City office buildings that you will recognize, including 57 West 57th and 28 and 40 West 23rd Street. In these capacities, his responsibilities include overseeing the leasing, management, and repositioning of these properties. Michael is also chairman of the board of the Business Improvement District, known as the Flatiron Nomad Partnership. He serves on the boards of the Roundabout Theater Company, the Jewish National Fund of Greater New York, and he is, podcast first, also a Tony Award-winning producer of A Gentleman's Guide to Love and Murder. So, welcome to the podcast.
Thank you very much, Rob.
So, this is an exceptionally interesting topic right now because we're going to be talking about a lot of different subsectors right around here. So I'd like to just start from the top. The office market is undergoing a massive evolution right now. How does the current market pressure compares to the other ones that you've experienced over your career?
So while we can learn from the previous business cycles, and we do, it seems each time we hit a downturn, there's a different explanation, something new, and not the same old, same old. In these circumstances, of course, the new addition to our world was the pandemic. And there was really a one, two, three punch that took place. The obvious first punch was the absence of workers from office buildings. But the second punch was the impact of the much needed new construction here in the city, most of it taking place over at the Manhattan West and the Hudson Yards, and also near Grand Central at One Vanderbilt. And these new buildings, unlike prior recessions, these new buildings ended up hoovering up occupancy from the Midtown core and outperforming, I think, even their own developers' expectations in terms of rents and lease up. They are fabulously successful, but they left gaping holes. The third punch was interest rates. And so we had interest rates on top of a vacancy rate that had been driven up by the one-two punch of the pandemic and the new construction. And that's the rise in interest rates is proving to be an existential threat for some of the investments made in the prior market cycle.
Okay, so it sounds like I didn't really think about the last one that you mentioned there, which is the development of One Vanderbilt and some of the things over on the west side. So there was also an evolutionary pressure here also in the evolution of styles of the buildings, the kit of the building, et cetera, that sort of leapt, if you will.
So for much of my career, a new building in New York City, modern building, was one that was built in the 80s or 90s. I mean, there was basically a generation of new construction that was left behind. And clearly, over time, tastes changed, technology changed, the the desire for ecologically and ergonomically configured buildings changed. And so when the new buildings came on the scene, there was just a burst of enthusiasm, and tenants voted with their feet.
Yeah, yeah. I mean, this is all, exceptionally interesting to me because one of the things that a lot of investors don't often learn from are evolutionary jumps like that, but they're inevitable. So I guess maybe we want to talk about what happens to the other ones. We have what will happen to you think to the large number of lenders whose deals are set up for interest rates that we are unlikely to see anytime again.
Well, there's a day of reckoning occurring right now and looming, and we're going to see the repercussions for a couple of years, is my guess. There are a few possible outcomes. The lenders, some of them will work things out with their borrowers, meaning either help them buy some extra time by deferring a foreclosure or a deed in lieu or a short sale, or where the borrower is capable of putting equity into the building or raising new equity, they'll justify a continued ownership and restructure and be ready to face the economic realities, the rents, the cost of improvement allowances, the things that have made life harder for owners of buildings that weren't built in the last 5 years. That will be a small subset. There will be other occasions where we will see owners hand back the keys voluntarily, and we've seen that at a handful of buildings already. I think the first one, the canary in the coal mine, was 1740 Broadway, and but we've also seen it over on Times Square, where SL Green and RXR gave the keys back to Apollo, and that building is 5 Times Square is going to be converted into residential apartments, and so some of these buildings will be retooled for a completely different use. And that will enrich the city, although it's going to be painful for the last generation of investors. And so there's no definitive outcome. It's a building by building basis. Will this get worked out? Should this still be a commercial office building? Is there some other use that it can be put to? And how do the parties coalesce around these options?
Right. So this is exceptionally interesting to me as someone who used to work in wealth management because I'm always looking for the rare thing that's a good opportunity. And my suspicion is there are some there. But before we get to that, let me go back to something else because there's a lot of macroeconomic stuff going on that touches on many of those things. It touches on interest rates, the macroeconomic stuff is touching on cap rates. There's just a lot going on. So could you talk a little bit about your view from the uncertainties in the macro scene?
Sure. Well, first of all, I'd like to mention how real estate investment took place over the 10 years running up to the pandemic because it's instructional. What happened was the industry, there was so much demand for commercial real estate, particularly in New York, and a sense that it was terribly liquid, that we lost sight of cash flow and the benchmark that I was raised on, ROI, return on investment. And so the idea that you would invest millions of dollars and you were entitled to an annual return, and whether you held it for 3 years or generationally, um, that was your prize. Um, the ROI concept was replaced by IRR, internal rate of return, which is a computation that takes into account the ROI in part, but weighs heavily on the sale of the asset after a holding period. And because time is your enemy, because you've got a discount rate that makes a dollar earned in a year later or a year later worth less than a dollar earned sooner, the IRR calculation inspires you to hold for less time. The idea of holding an asset generationally became an outlier, and the idea of worrying about your ROI, your return, was ignored. And every asset was purchased with an idea that it would be sold in a handful of years for a handsome profit, and most of the return was to be achieved at that moment of sale and in that profit. And so that relied very heavily on the continuity of a low interest rate environment and a low cap rate environment. And those fundamental assumptions have proved wrong.
Okay. Well, so I think the audience here will warm to what you're saying because most of them took the CFA exam long enough ago that they had to calculate ROI and IRR on paper. So they're exceptionally well aware of the
Okay, well, I'm sorry if I was
no,
speaking to a lower denominator.
I'm just want to recognize their pain. So, so take us forward a little bit in
Right.
sort of the macro scene from there, because that's exceptionally helpful in setting the stage. But let's move on
Okay,
to the.
so now IRRs are very unpredictable today because we don't know what interest rates are going to look like, and we don't know what cap rates, which theoretically follow interest rates in lockstep, but there are some additional factors that influence cap rates, such as the the widespread demand for an asset class, which can lower a cap rate even when interest rates are held constant. But right now, I think we have a new administration. We've just had an election, And there are certain things that are coming out of the new administration that are very encouraging for business, right? Lower tax rates theoretically should feed demand for office space as companies have profits to plow back into their infrastructure. On the other hand, there are some policies being debated that could be very inflationary. People are concerned that if inflation is stoked again and the Fed remains independent, that interest rates will not fall at the rate they have been anticipated to fall at. And if interest rates don't fall, then cap rates won't fall. And I can't tell you with any kind of certainty 5 years from now when deals that are bought today, right, which are the numbers are being run and the IRRs are being calculated, whether the exit cap rate is going to be 7%, 6%, 5%. But I can tell you that 100 basis point difference in the cap rate has an extraordinary effect on the exit value of an asset, and much more than whether you're renting for 70 or 72 or $75 a foot. The needle moves exponentially faster when you adjust the exit cap than it does when you adjust your rental assumptions.
Right. Yeah. I mean, this is the hard part, right? The exceptionally hard part, and what's making, I presume, making a lot of people who might deploy capital now pause a little bit, because with that level of uncertainty in their calculations, what are they doing?
Well, they're aiming high, right?
Mhm.
They're aiming high in terms of their IRRs, and they're aiming low. Sorry, I should say high in terms of their exit caps.
Right.
The underwriting is extremely conservative right now, and many of the typical investors are sidelined. They're talking about yes for a special deal, something we always keep our eyes open, and but the asset class that is on everybody's wish list today is not New York City or CBD office. I still feel like that's a four-letter word, but to for me, that's also an indication that this is probably the right time in the cycle to think seriously about how you can participate in acquiring assets because they are being acquired. Liquidity is returning to the system, and this feels to me like the way my father must have felt in 1977 when the city was a disaster, and yet any real estate purchased in or around that year proved to be incredibly accretive.
Right. And this is one of the reasons I was exceptionally interested in having you on this podcast, is because you have a massive track record with B buildings.
Yes.
You have an exceptionally good view into this, and the term of your view is exceptionally good. So, what do you look for in that area of the buildings now? What do you actively look for?
Sure, sure. Well, I think what some of the B building detractors, and there's been a lot of press detracting. Yeah,
Yeah.
it's somewhere between an onslaught and a litany. But I think what the detractors fail to see is that within the category of B buildings, there are gradations. There are the A's of the B's, the B's of the B's, the C's of the B's, and these gradations are a function of the quality of the light and air, the configuration of the floor plate, the location, the common areas, the amenities, just as they are with the Class A buildings. It's the same criteria. And at the same time, there's also a, a constituency, a demand for B buildings. And there is space leasing in B buildings in this town every day of the week. And there are tenants out there who are not candidates for the Hudson Yards or the Plaza District overlooking Central Park that want B buildings. So we have to be competitive. And the biggest challenge for B buildings is that whether you're building space in a B building or an A building, um, it's still expensive to build. Construction costs have been driven up over the last several years, and landlords are now contributing triple digits to each and every foot that gets leased in this town, whether they're pre-building it or doing a turnkey. tenants, for the most part, want, especially in the B buildings, the landlord to lay out all the capital. And that capital, that amount of capital, is sometimes the equivalent of 2 years' rent or more. Right. Well, and so if you're signing a 5-year lease and you're giving an abatement and you're spending 2 years' rent, the math is very daunting because you're giving up half your income up front. But we have ways that we cope with this. We have to be well capitalized, but also we're looking at building spaces in a way that we won't have to rip out and start all over 5 or 10 years from now. And unfortunately, from the last leasing cycle, let's say over 10 years ago, or in the early 2000s, the way space was used and configured is very different from the way it's used today, and a lot of what was built then just doesn't work and has to be ripped out. We're trying to avoid making that same mistake, building things that are flexible, generic, attractive, but will have some longevity. So when we spend 2 years worth of rent to build space for a 5-year lease, we anticipate that after 5 years, we may paint and carpet, we may do a refresh, but we're not looking at spending those 2 years worth of rent again.
Right, Michael, this is fascinating because I never hear anyone talking about the any kind of traffic or any kind of measure of B buildings. One Vanderbilt sucks a whole bunch of the air out of the room, and the so this is exceptionally valuable to hear. You talked a bit about capitalization, and one thing I would really like to talk about is the other thing that's happening in addition to interest rates uncertainty. There's a lot of uncertainty around lending, and it's changing a lot right now. So where are commercial borrowers getting capital from now? And do you think are the systemic risks to this type of lending?
So let's talk about where we came from and then where we are today. Before the pandemic, I could borrow money for a reasonably stabilized, in other words, didn't have to be fully rented, stabilized office asset with a couple of phone calls. And I could say to myself, am I going to go call my regional bank? Am I going to call a life co? Am I going to call one of the big money center banks and do a CMBS execution? I was like, sitting at a restaurant with a menu and, appetizer, main course, and sides with lots of choices on each. Okay, today the menu is bare. um, so basically, if you have a sufficiently stabilized asset, the CMBS market is alive and kicking, and those guys will beat down your door for an opportunity. And there's robust competition between the money center banks, and there are nuanced differences between the executions that each bank offers. And you do your homework, you figure out where your bread is buttered. But the life cos seem to have checked out, and the regional banks are only doing deals with their depositors where there's a special relationship. So, and if your property is not stabilized, then you're left with the high octane funds who have gone into this sector. As one said to me a year ago, this is terrific because we're now lending in the first position as the primary lender at the rates we used to get for mezzanine loans.
Right.
So we have the safety of the first position and we have the returns of our mezzanine portfolios. So they're just happy as can be. We try to avoid those borrowing circumstances, but there are folks doing it every day that have no choice.
Right. Right. Do you think that it introduces a risk into the marketplace? Because I mean, just to go back for a second, a lot of the CMBS market, as I understand it, is single borrower deals. Right. This isn't the CMBS of the pre GFC days. These are all single borrower deals. I think, right? So there are some obvious risks that everyone knows. What about these sort of the high octane lenders you're talking about? Do you think there's systematic risks to those folks?
Well, I think that these folks are sophisticated, and if they have to step in to take a property back, they'll do it. And we've seen some of that already. And I think they're making a calculation, right, that says, well, if the loan doesn't pan out and I end up owning this thing at at this basis, I'm content. So I think we'll see. It's not exactly loan to own, which implies I'm kind of predatory and I'm coming in there with rescue capital, but I'm not sure if I'm rooting for my borrower or rooting against him. These are people, they're rooting for the borrower. They're not going in there with that attitude, but they're content. They've reasoned through the risk reward. So I think from the marketplace's perspective, one does need to do their due diligence. If one is a tenant or a vendor, you have to say, how sure am I this guy's going to pay his bills? And if there is a problem with their lender, um, how exposed am I? And how much risk am I prepared to take?
Right. So,
And how do I mitigate?
right. So it's good old underwriting.
Yeah, yeah.
It's,
No,
well, well, thank you, Michael, for being here on the podcast. This is an excellent view into this. And thanks again for pointing us towards the B office buildings, which don't get enough attention, but I'm sure have some type of value in them.
well, I'm sure too.
And thanks to everyone for listening to this podcast. This is Commercial Real Estate Month at Compound Insights. So I hope you tune in for the next episode. Until then, I'm Rob Rowan, and this has been Compound Insights.